Two neighbors, both 62, both stepping into retirement, with $1,200,000 sitting in their accounts. One of them follows the plan you hear everywhere, and by the time he is done, he hands over close to 24% of that money to the IRS over the next 30 years. His neighbor uses a different order of withdrawals and pays only 9%. That gap works out to roughly $214,000 that stays in one man's pocket instead of leaving for Washington. Here is the part almost nobody explains. The standard advice assumes you have a large taxable brokerage account to live on first, so you can keep your income low and grab an ACA subsidy while your 401k and IRA sit untouched. Most people this age do not have that brokerage account. Their money is trapped inside a 401k or an IRA. And if they follow that same standard sequence anyway, they walk straight into something called the Social Security tax torpedo, a stretch of income where pulling one more dollar from an IRA can get taxed at an effective rate of 40.7%. That is not a typo. It happens because, for a chunk of your retirement years, every dollar you take from a pre-tax account does not just get taxed once. It also drags more of your Social Security benefit into taxable territory, so you end up paying tax twice on money you already earned once. Today, I want to walk you through the sequence that avoids that trap, even without a brokerage account sitting on the side. It centers on a mechanism called a 72T SEPP, which lets you pull from a 401k or IRA before 59.5 without the usual 10% penalty, and it is how you keep your lifetime tax rate under 15% instead of drifting up toward 24%. This is not about dodging taxes you owe. It is about paying them on your terms instead of the IRS's terms. I have sat across from retirees who did nearly everything the calculators told them to do, and they still got surprised by this one. It is worth slowing down for a moment, because the mechanism is simple once you see it laid out. Social Security uses something called provisional income to decide how much of your benefit gets taxed. It adds up half of your Social Security check plus your other income for the year, including anything you pull from a 401k or an IRA. Once that combined number crosses a certain line, up to 85% of your Social Security becomes taxable, stacked right on top of whatever tax you already owe on the withdrawal itself. Picture a couple bringing in $40,000 a year in Social Security. They need another $30,000 from an IRA to cover the rest of their bills. That $30,000 does not just get taxed at their normal bracket. It can also drag $25,500 or more of their Social Security into taxable territory at the same time. Add it up, and the effective tax rate on that last dollar of IRA withdrawal can climb past 40%, higher than what plenty of six-figure earners pay on their salary. With the 2026 cost of living adjustment pushing benefit checks up 2.8%. More retirees are sliding into this zone sooner than they expect, not later. Most retirement plans skip the next part entirely. The usual advice is to leave the IRA alone, live off Social Security and a brokerage account, and stay out of this zone completely. That works fine if you actually have a brokerage account sitting on the side. If you do not, waiting does not make the problem disappear. It just delays it to age 73, when required minimum distributions force you to pull money out of that IRA whether you need the income or not, landing directly on top of Social Security on the same tax return. That is the trade-off nobody puts on a slide. Avoid the torpedo now by leaving the IRA untouched, and you are quietly building a bigger mandatory withdrawal for later, one that arrives at the same time as Social Security, except now your bracket is already set and you have far less room to shift things around. None of this means you did something wrong by saving diligently in a 401k instead of a brokerage account. Most employer retirement plans only ever offered pre-tax savings for years, so almost everyone this age ends up in the exact same spot. The gap only shows up because nobody explains the fix. So what do you do when your money is stuck inside a 401k and there is no brokerage account to lean on while you wait? There is a way to reach that money early, on purpose, without paying the 10% penalty and without waiting around for the torpedo to catch up with you. Here is the strategy I use with people in exactly this spot. Pre-tax accounts, real Social Security coming, and no brokerage account to smooth things out. Call it an income smoothing approach, and it comes down to two questions, worked through in order. First question, does the rule of 55 apply to you? If you left your job in or after the calendar year you turned 55, you can pull money out of that specific employer's 401k penalty-free, even though you have not reached 59.5 yet. A lot of people never check this, and it quietly costs them years of flexibility they already earned. Second question, if the rule of 55 does not apply, maybe you rolled that old 401k into an IRA already, or you left the job well before 55, you can set up a 72T SEPP instead. That stands for Substantially Equal Periodic Payments, an IRS-approved withdrawal schedule from your 401k or IRA that lets you access the money before 59.5 without the 10% early withdrawal penalty. The trade is that you commit to the schedule for 5 years or until 59.5, whichever runs longer, so this takes real planning, not a rough guess on the back of an envelope. Here is why either path matters more than it looks like on paper. Say you start pulling $45,000 a year from your IRA at 62 before you ever file for Social Security. On its own, that income keeps you inside the 10% or 12% tax bracket. You are effectively prepaying tax on that money at a discount. Years before the torpedo from the last section would have taxed the same dollars at 40% or more once Social Security entered the picture. Think about what that money is doing in the meantime. It is covering a mortgage payment, a car payment, insurance premiums, the ordinary bills that do not pause while you wait for a tax bracket to look better on paper. Whether that money comes from Social Security or from a 401k withdrawal, it spends the same. The only question is how much of it the IRS keeps. That is the trade-off worth sitting with. It feels backwards to touch a 401k early on purpose. Almost everything you have heard says protect it, let it grow. Wait as long as you possibly can. But when there is no brokerage account acting as a buffer, waiting is exactly what hands more of your money to the IRS later, not less. I used to tell almost everyone the same thing, leave the IRA alone until 59.5, no exceptions. I was wrong about that, at least for this situation. If you do not have a brokerage account to lean on, touching the IRA early through a 72T or the rule of 55 is the mathematically stronger move, because it protects your future Social Security from getting taxed twice. If you are looking at your 401k right now and realizing it might be a bigger tax bill than you planned for, stick around. We specialize in exactly these messier, no brokerage account retirements that the big firms tend to skip past. One more practical note before moving on. A 72T schedule is not something you eyeball. The IRS allows a few specific calculation methods for setting the payment amount, and your custodian, whether that is Fidelity or Vanguard or another provider, needs the paperwork filed correctly from day one. Get the number wrong or stop the payments early, and the IRS can retroactively apply the 10% penalty to every withdrawal you already took. That is the one place in this whole plan where it pays to get help rather than guess. A lot of retirees fixate on one number, the ACA subsidy. Keep your taxable income low enough, and you can knock roughly $15,000 a year off your health insurance bill. It feels like free money, and for plenty of families it genuinely helps in the moment. Here is what that same decision costs later. If you have $1,200,000 sitting in a traditional IRA, your required minimum distributions at 73 are going to run somewhere around $45,000 a year or more, stacked directly on top of Social Security, whether your income needs it that year or not. Every year you kept income artificially low to protect that subsidy is a year you did not shrink that future bill. Picture two versions of the same retiree. One takes the $15,000 subsidy every year and pays close to nothing in tax today, but ends up paying something like 24% on a much larger required minimum distribution for the next 20 years. The other skips the subsidy and converts $50,000 a year from the IRA into a Roth account instead, paying roughly 12% tax on that money now while the bracket is still low and there is room to work with. Run the math over 5 years, and the second retiree gives up around $75,000 in subsidies. But they save more than $80,000 in future taxes on that same money, and they sidestep the Medicare surcharges, called IRMA, that hit higher-income retirees once large RMDs push their Medicare premiums up along with everything else. One bill got traded for a smaller, more permanent one. It is not a comfortable trade to look at on paper, giving up help you can see today, a lower grocery bill in effect, to avoid a tax bill you cannot see yet, takes some trust in the math. But there is a piece of the 2026 tax code that makes that Roth conversion cheaper than it has been in years, and almost nobody has factored it into their plan yet. Notice what actually drives this decision. It is not whether the subsidy feels good in the moment. It is which bill is easier to control, a health insurance premium you can shop and adjust every year, or a required minimum distribution the IRS calculates for you once your account balance reaches a certain size. One of those two bills you get a say in. The other one you do not. There is a piece of the tax code working in your favor right now, and it comes with an expiration date attached. Under the One Big Beautiful Bill Act, anyone 65 or older gets an additional $6,000 deduction on top of the usual standard deduction, or $12,000 total if you are a married couple and both of you are 65 or older. That deduction phases out once your income climbs high enough, above $75,000 in modified adjusted gross income for a single filer or $150,000 for a married couple filing together. Underneath that ceiling, it behaves like a wider zero tax bracket, sitting right on top of your usual deductions. That extra room feeds directly into everything covered so far. It lets you convert more to a Roth account, or pull more out of your IRA through a 72T schedule without spilling into the next tax bracket. It is a bigger window to move money through at a low rate before the torpedo from earlier, or the required minimum distributions later, show up and take a bigger cut. We have not seen a senior-specific deduction this generous since before the tax code changes back in 2017. It is scheduled to run from 2025 through 2028, a 4-year window, not a permanent feature of the tax code. Once it expires, the extra room disappears along with it. If you let that window close without using it, you are leaving something like $12,000 a year in tax-free room on the table every single year it was available. Add that up across 4 years for a married couple, and it becomes real money, gone the moment the calendar turns. It helps to picture the two versions side by side. A couple who ignores this deduction converts the same amount every year regardless of the calendar, and pays tax on all of it as though the window never existed. A couple who plans around it deliberately pushes an extra $12,000 of conversions or withdrawals into this specific 4-year stretch, at 0% tax on that slice, simply because the rule happens to be open right now. Same accounts, same balances, different amount handed to the IRS. Picture this scenario. At some point in the next few years, the market drops 20% in a matter of months. You are in the middle of exactly the plan laid out so far, pulling from your IRA, converting some to Roth, keeping your bracket steady year to year. Most people panic in that moment. They pause their Roth conversions, telling themselves they are stopping the bleeding, but they still need cash to live on. So they keep pulling from the IRA anyway, selling shares near the bottom of the drop to cover the mortgage and the electric bill. That locks in a loss on the exact shares that were about to recover, turning what was only a paper loss into a permanent, locked-in one. The fix is not complicated, but it has to be in place before the drop happens, not after. Keep something like 2 years of living expenses sitting in a high-yield savings account or a money market fund, completely separate from your invested accounts. If your monthly budget runs $4,000, that means holding roughly $96,000 in cash before the drop ever shows up, not scrambling to raise it once the market is already down. When the market drops, you draw from that cash buffer instead of selling shares at a discount, and your invested money gets the time it needs to recover. This next part is the one that tends to surprise most people the first time they hear it. A market drop is actually the best time to accelerate your Roth conversions, not pause them. If your S&P 500 holdings are down 20%, converting the same dollar amount moves more shares into the Roth account, since each share is cheaper. When the market recovers, and it has recovered after every major downturn including 2008, all of that growth happens inside the Roth, completely untouched by the IRS from that point forward. I remember a client in 2022 who was genuinely afraid to convert while his account was down close to 19%. We went ahead with it anyway, on schedule, no different from any other year. Today, that Roth account runs roughly 40% larger than it would have if he had waited for calmer markets. And none of that growth will ever show up on a tax return. None of this requires guessing exactly when the bottom hits. And you do not need to time the recovery perfectly either. The cash buffer is what buys you the ability to keep the plan running on schedule instead of tearing it up out of fear. A drop is uncomfortable to watch, but it stops being dangerous the moment your grocery money and your mortgage payment no longer depend on selling shares that particular week. If you want to put this into practice, here is the order to work through it in. First, figure out your tax-free zone for the year, your standard deduction, plus that extra $6,000 senior deduction if you qualify for it. That is the amount of income you can generate through withdrawals or conversions before you owe a single dollar of federal tax. Second, check whether the Rule of 55 applies to your current 401k. If you left that job in or after the year you turned 55, that door is already open to you. Third, if that door is closed, look at setting up a 72T SEPP schedule to bridge the years between now and 67, your full retirement age. This takes planning since the schedule locks in for years at a time, so it is worth working through carefully rather than rushing into it. Fourth, where it fits your situation, consider delaying Social Security to 70. Every year you wait past your full retirement age, adds about 8% to your benefit permanently. Wait the full 3 years from 67 to 70, and your check comes in about 24% higher, guaranteed, on top of whatever the annual cost of living adjustment adds on its own. None of these 4 steps work well in isolation. They work together, and the order you tackle them in matters more than any single piece of it on its own. If you found this useful, stay subscribed. Next, we are going deep on IRMA, the Medicare surcharge that quietly catches people who convert too much too fast. Write these 4 steps down in the order given, and revisit them once a year, not once and done. Your tax-free zone changes as the standard deduction adjusts. Your Rule of 55 eligibility does not change once confirmed, and your 72T schedule, once started, needs to stay on track. A yearly check with a CPA who actually looks at your specific numbers costs far less than 1 missed step costs later. You do not need a large brokerage account sitting on the side to build a smart retirement plan. Between the 72T bridge, the Rule of 55, and this year's senior deduction, you have real tools to spend your own money now, while it is taxed at 10% or 12%, instead of waiting for a torpedo that taxes the same dollars at 40% or more later. Retirement was never really about finding the single lowest possible tax bill on paper. It is about ending up with the highest net income you can actually live on comfortably, year after year, for as long as you need that money to last. Sometimes that means paying a little more tax today on purpose, because the alternative quietly costs more down the road. None of this asks you to become a tax professional overnight. It asks you to understand the order things happen in, so a decision that used to feel automatic, like which account to pull from first each year, actually gets made on purpose instead of by default. Do not let the tax code decide how you live. Use the math to fund the life you actually want to live. I will see you in the next one.